Friends, let's rewind the clock exactly 60 years. Back in 1965, there was a young investor named Warren Buffett. At that time, he put money into a struggling company called Berkshire Hathaway. And no, Berkshire wasn't some legendary investing empire back then. It was a small, beat-up textile manufacturing business that was barely surviving. The stock was trading around 7.50s per share. Buffett believed it was undervalued. On paper, it looked cheap. So, he invested heavily. And then something important happened. He realized it was a mistake. The business itself wasn't good. Management was weak. The core textile operation had no real future. It wasn't the kind of company that could compound value long term. Instead of walking away, Buffett made a bold decision. He took control. In 1965, Warren Buffett became the chairman and effectively started running the company himself. From that moment on, Berkshire Hathaway stopped being a textile company and slowly transformed into something completely different. Fast forward 60 years. That same stock that once traded at $7.50 went on to trade at hundreds of thousands of dollars per share. That's roughly a 100,000x increase over 6 decades. In percentage terms, that's millions upon millions of percent of growth under Buffett's leadership. That kind of result doesn't come from luck. It comes from principles. And recently, in 25, Warren Buffett officially announced that he is stepping away. No more new annual letters, no more showing up at annual shareholder meetings. For decades, those letters were like a free masterclass in investing, business, and decision-making. And now, that chapter is closing. So, in today's video on No Cap Finance, we're breaking down the most important lessons from Warren Buffett's journey and his final letters, lessons that still matter for regular Americans trying to build wealth today. Lesson number 1. Stop obsessing over stock price. Focus on value. One of the most common questions people ask is this. This stock is already expensive. How much higher can it really go? People look at a stock trading at hundreds or thousands of dollars per share and assume it's too late. But here's the reality. A $2 stock can still crash 80 or 90%. And a stock that already looks expensive can still go up another 100 or 200% or more. So the real question is not, how high can this stock go from here? The real question is this business creating real value for its customers and its shareholders? If a company keeps creating value, the stock price will eventually follow. There is no fixed ceiling. This is exactly what Buffett focused on at Berkshire. He didn't chase hype. He didn't care about daily price movements. He focused on building long-term value, better businesses, better capital allocation, better decision-making. And this lesson goes way beyond investing. In your personal life, the same rule applies. The more valuable your skills become, the more reliable you are. The more problems you can solve, the more your income and net worth tend to grow over time. Focus on value. Wealth follows. Lesson 2. Financial assets can create wealth, but they also attract fraud. There's a quote Buffett shared that hits hard. Over decades of investing, he and Charlie Munger saw massive accounting frauds involving staggering amounts of money. And in many cases, very few people were ever truly punished. That's a reality most people don't like to talk about. Financial fraud doesn't disappear. It just changes form. Here's the key idea you need to understand as an investor. There's a difference between physical assets and financial assets. Physical assets are things you can see and touch. Real estate, gold, silver, they're harder to fake, harder to manipulate, and fraud is more obvious. Financial assets, on the other hand, are contracts, stocks, bonds, digital account balances. Most of the time, you don't even hold paper anymore. It's just numbers on a screen. That doesn't mean financial assets are bad. In fact, they're often the best way to build long-term wealth. But it does mean you have to be more careful. Scams will always exist. Shady companies will always exist. Smooth-talking people promising guaranteed returns will always exist. One bad experience causes a lot of people to swear off investing forever. They retreat into cash, CDs, or only physical assets, and then wonder why their wealth never really grows. The lesson isn't to avoid investing. The lesson is, if something feels unclear, rushed, or too good to be true, walk away. Lesson 3. Stay inside your circle of competence. Let me ask you a question. How do you beat a world chess champion? The answer is simple. You don't play chess. You play a game where you have the advantage. That's the idea behind Buffett's concept of the circle of competence. You don't need to understand every industry. You don't need to invest in everything. You don't need to chase trends you don't fully understand. You just need to stay within areas where you genuinely know what's going on. Even after decades in the market, Buffett still avoided businesses he didn't understand. And this lesson matters even more for regular people. Some folks say things like, I'm going to sell my house, put everything into the stock market, and live off withdrawals. That might sound smart on paper, but if you don't understand volatility, risk, and your own emotional limits, one bad market crash can wipe you out, financially and psychologically. Many investment losses don't come from bad markets. They come from people stepping outside their limits. Know what you understand, respect what you don't, and don't confuse confidence with competence. Lesson 4. You will make mistakes. Don't get stuck in them. In his final letters, Buffett was very clear about one thing. You will make mistakes. Everyone does. Even him. He openly admitted to misjudging companies, overpaying for acquisitions, and missing opportunities. And instead of hiding those errors, he wrote entire sections explaining them. The real danger isn't making a mistake. The real danger is delaying the correction. Buffett warned against what Charlie Munger used to call thumb-sucking, sitting around wishing things had gone differently instead of taking action. If you made a bad investment, learn from it, fix it, move forward. Growth comes from learning, not from regret. It's never too late to improve your decision-making. Lesson 5. Choose your heroes carefully. In the final lines of his final letter, Buffett wrote something powerful. Choose your heroes carefully, and then emulate them. Why did he say this? Because who you admire shapes who you become. Buffett once explained that if he knows your role models, he can predict your future behavior. If you look up to people who value integrity, patience, and long-term thinking, you'll slowly adopt those traits. If you idolize shortcuts, hype, and attention at all costs, that path usually ends badly. Buffett shared the story of Alfred Nobel, the inventor behind dynamite. Nobel once read his own premature obituary, which labeled him a merchant of death. That moment shocked him into changing how he wanted to be remembered. His legacy became the Nobel Prize instead. The lesson? Don't wait for a wake-up call. Decide how you want to be remembered, and live in a way that earns it. Final takeaway. If we pull everything together, Buffett's life teaches us this. Focus on value, not price. Keep learning for life. Avoid bad people and bad deals. Stay within your strengths. Learn quickly from mistakes. And choose role models who build you up, not tear you down. That mindset doesn't just build portfolios. It builds lives. This is No Cap Finance. If you want deeper breakdowns of Buffett's letters and timeless investing lessons, let us know. Thanks for giving us your time, and we'll see you in the next one.